In today's market update, we're going to be taking a look at the Dow Jones Industrial Average. My name is David Hickson, and today is the 11th of October 2018. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. In the past two market updates, we have taken a look at the S&P 500 and the Nasdaq 100, both of course US stock markets. And in both videos, I have discussed the fact that a peak has been expected in those markets. In the S&P 500, I spoke about a 40-week magnitude peak. And in the Nasdaq 100, I stepped back and took a look at a bigger picture and spoke about a potential 18-year cycle peak. So in today's video, we're going to take a look at a third US stock market, the Dow Jones Industrial Average, and speak about the peak that is also expected in this market. Because, of course, Hurst defined a principle, the principle of commonality, which tells us that markets tend to move with a great deal in common. And what that means in cycle terms is that the cycles that are influencing one market tend to influence another market. And so, therefore, markets move with a great deal in common. They tend to form troughs and peaks at about the same time. And so the peak that we are expecting, the bigger picture, is an 18-year cycle peak, as discussed in our previous video. The other possibility is that the peak that's forming right now is only of 40-week magnitude. Now, 40 weeks is still quite a big peak. It's 40 weeks is about 9 months. And so that's a fairly big peak. But overshadowing that is the possibility that this is an 18-year cycle peak. So let's speak about this. Here is the default analysis that Sentient Trader has performed. In other words, I haven't influenced this analysis at all. And you can see that we're looking here only at the peaks at the top of the chart. Of course, I have performed a trough analysis, which is here at the foot of the chart. But I'm not going to speak about the trough analysis today because as the market is approaching a really big and important peak, as you can see from this nest of highs over here, that is the nest of highs for a 9-year cycle peak in this analysis. The 18-year cycle peak isn't included in this analysis because I don't have quite enough data for the software to confidently place an 18-year cycle peak. So it's only showing me cycles up to 9 years. But we need to bear in mind that if we had more data, and we could, of course, analyze more data, we might be looking at an 18-year cycle peak. But it's really splitting hairs whether we're looking at an 18-year cycle peak or a 9-year cycle peak. That's an academic point, in my opinion, because if price is going to drop out of a 9-year cycle peak, it's going to be pretty nasty. And if it's dropping out of an 18-year cycle peak, well, it's also going to be pretty nasty. So, because the market is approaching a peak, I'm focusing on the peak analysis, and I'm not even looking at the trough analysis today. We'll discuss trough analysis at a later time. And the first thing that should be said, of course, is that stock markets are influenced by cycles that have synchronized troughs. And I spoke about this in the previous video, so I won't dwell on it. But the point is that most stock markets tend to have very sharp, isolated troughs, and they tend to have rather rounded and clustered peaks. Okay, it's a generality, but that is how stock markets usually move. I spoke in the Nasdaq video about the interesting features of the Nasdaq because it tends to exhibit slightly different characteristics. Nevertheless, you should be aware that a peak analysis is inevitably going to be less reliable, and so we have to approach a peak analysis with some caution. But you can see here that there are some fairly obvious peaks in this market. There they are over there. And there is a bit of a peak that formed in 2015, which we'll speak about again in a moment. And if we measure the time from that peak that was right at the beginning of 2000, I believe, then you can see that the time that has elapsed since then is 18.64, 18.7 years roughly. The average length of an 18-year cycle discovered by Hurst way back in the 1970s is 6,552 days. So now the January peak that occurred at the beginning of this year was 6,596 days. So it was only 44 days late for a potential 18-year cycle peak, and or at least 18 years since the peak in the year 2000. And so clearly we are expecting a very big magnitude peak to form at the moment. The amount of time that has elapsed since the 2007 peak is at the moment getting a little bit on the long side, 4,053 days, and the January peak was 3,763 days. So that's a slightly stretched peak. That's a slightly stretched wave, I should say, in terms of the wavelength. The average length of the 9-year wavelength is 3,276 days, and you'll see that if we move our mouse over 3,276 days, that meant that we would have been expecting that peak to occur in about late 2016. So again, I'm going to come back to that in a moment, because there are some possibilities in terms of what is happening in this analysis. So because of the amount of time that has elapsed since those obvious peaks in 2000 and 2007, clearly we are looking at a really big peak forming in the markets at the moment. And if I zoom in on this chart, then you can see up at the top here we've got a very staggered nest of highs. There's the 54-month and there's the 9-year circle for that nest of highs. And so clearly the market potentially, according to this analysis, is moving into a really long, really big magnitude peak, probably 9 years, possibly even 18 years in magnitude. So let's speak about the staggered peak, because normally you would like to see, or I should say the staggered nest of highs. Normally when you see a nest of highs or a nest of lows, you would expect to see your circles all very nicely lined up, as you see here for that nest of highs further into the future at the end of 2019. You can see the circles there are all very nicely lined up. Let me clear that, and you can see those circles all very nicely lined up. That's a very clean nest of highs, whereas what we have in the market at the moment is not so clean. I like to sometimes draw lines between these circles, because then that gives you an idea of that nest of highs, how clean it is or how staggered it is. When you get a really staggered nest of highs or nest of lows, it indicates that the different cycles in the analysis are not perfectly in sync. And some of them have much longer wavelengths than they should have, and some of them have much shorter wavelengths. And so you're getting this sort of staggered action that's occurring. It doesn't reduce the impact of that nest of highs. It tells us that indeed we are expecting a peak, but it tells us particularly that the 54-month cycle peak is now overdue, because it was expected in the first few months of 2017. And the 9-year cycle peak is also overdue, because it was expected towards the end of 2017. What's that, about September of 2017. So those peaks are overdue, but they're really long cycle peaks. So I'm not going to hold it against the 9-year cycle peak if it has come in about a year late. That's not a really big variation. And that's the important thing. You need to look at the cycle wavelength and work out how big that variation is. So we have this nest of highs, and we're definitely approaching a peak. According to this analysis, as you can see, I won't zoom in just yet, but you can see that the analysis has the 40-week cycle peak here in January, and therefore it's been counting the shorter cycles. Therefore the next peak that is due to form is of course this really big peak. So potentially this peak that formed here, I believe the high price was at the end of September, or might even have been really sort of early October, that peak is probably the big peak that we have been expecting. But when you're expecting a really big peak and it's only been a few days or a week or so after that peak forms, you can't jump to the conclusion that it is definitely a peak of that really big cycle. So what peak is it definitely a peak of? In other words, what peak has almost certainly formed in this market? Well, what we do is we measure the number of bars from, and in fact we'll count the bars from that point over there, and you can see that the number of bars that have passed since the January peak is 257 bars, or 36.7 weeks. Of course, we do count the bars over the weekend because Hurst said that cycles keep moving over the weekend. Now, the average length of a 40-week cycle is 272 bars, or 272 days, I should say. And so this peak over here, if this was a peak of the 40-week cycle, then the next peak of the 40-week cycle would have been expected in about 15 days. So, of course, here you can see the really big move that happened yesterday. We were all expecting a peak. I hope you've been watching these market updates, because anybody who's been watching these market updates would have known that we are expecting a peak. And when that big move down happened yesterday, there was a confirmation, certainly, that a peak of some magnitude is formed in the market. So what magnitude peak is it? Well, it is, in my opinion, at least a 40-week magnitude peak. Why is that? Well, because according to this analysis, that peak up there is a 40-week cycle peak. And 40 weeks after a 40-week cycle peak, you would expect a peak of at least 40-week magnitude to form. In fact, 40 weeks after a 40-week cycle peak, the next peak should, of course, be an 18-month cycle peak. So the chances are good that that is at least an 18-month cycle peak that is formed in the market. And because we're expecting a 9-year or potentially even an 18-year cycle peak, the chances are good that that 9-year cycle peak has now formed in the market. But the way that you work with Hurst cycles is you don't jump in a week after the high point in price and say, there we go, that's your 18-year cycle peak, and you place all your trades and you take an 18-year holiday. That's certainly not what we do. We monitor the situation really carefully, and we say this is a peak of at least 40-week magnitude. It might be an 18-month magnitude peak. It probably is, and it possibly is an even higher magnitude peak. And of course, the way in which we will confirm the magnitude of this peak as price continues to move is by using our cycle tools. So we will take a look at our FLDs. Oh, we've got quite a few FLDs. Let's clean this up a little bit. And in fact, let's look first of all at the 80-day FLD. And let me zoom in a little bit here. So when price crossed the 80-day FLD yesterday, that confirmed that the peak that has formed in the market is of at least 80-day magnitude. Okay, that's no big surprise. We are expecting the peak to be at least 80 days. The 20-week cycle peak, you can see, is just below where price stopped yesterday. So the 20-week cycle FLD is just about to be crossed, and when price does cross that FLD, it will confirm that the peak that is formed in the market is of at least 20-week magnitude, and so on. So we can keep looking at the different FLDs, and you can see there's the 40-week FLD, and here is the yellow FLD is the 18-month FLD. Now, I've mentioned that I think the peak is probably at least 18 months in magnitude, in which case we would expect price to cross down below that 18-month FLD. We can also take a look at the VTLs, and we've got several VTLs. First of all, the 40-day VTL, which is this blue one up at the top here. When price crossed that 40-day FLD, it confirmed that the peak was of at least 80-day magnitude. When price crossed the 80-day VTL, did I say FLD? I think I might have said FLD by mistake. When price crossed the 80-day VTL, it confirmed that the peak was of at least 20-week magnitude. VTLs, you add one cycle onto the cycle whose VTL is crossed. So the 80-day VTL has been crossed. Therefore, the 20-week cycle is confirmed as having formed a peak. And if we zoom out a little bit, I think you can see there's a cluster of VTLs down here. We've got the 20-week, the 40-week, and the 18-month VTLs. When price crosses down below these VTLs, or should I say if price crosses down below these VTLs, then we would have confirmation of a much longer peak forming in the market. So those are definitely levels to keep an eye on. Very quickly, just to end off this video, I mentioned earlier the fact that we had let me zoom all the way out, the fact that we had a kind of a rounded peak that formed in 2015. And I mentioned the fact that the 9-year cycle peak from late 2007 should have formed a bit earlier. That peak is overdue, as we've just seen. So is there something else that might be happening in this market? Is it possible that the price is not dropping out of an 18 or 9-year cycle peak? Yes, it is possible, and I'm going to just give you a glimpse of this other analysis and discuss it just for a minute or so. It is possible that the 9-year cycle peak formed at this peak over here in 2015. I think that's in about the middle of 2015. You can see that I've had to do some pinning on this chart. You can see the pin symbols indicating how I've had to influence the analysis. I believe that it's really important to experiment with your analyses a little bit and make sure that you're constantly aware of all the possible things that might be happening in the market. And so this is one possibility. We won't spend too much time going to the detail. Let's just zoom in. You can see I've had to pin the 54-month cycle peak, and I've pinned an 18-month cycle peak here. This is a possibility that the 9-year cycle peak formed in 2015. You might say, how is it possible that a 9-year cycle peak formed in 2015 and so soon afterwards price rocketed up again? We've got higher prices. How is that possible? It is possible if this trough over here was a 9-year cycle trough. That is how it is possible, because price would move from a 9-year cycle peak down into a 9-year cycle trough, and then it will continue moving upwards again. So this is a possible analysis. If this analysis turns out to be the correct one, then what is the magnitude of the peak that we are looking at? Well, if this is the correct analysis, then I believe that the peak in January of 2018 was only an 18-month cycle peak, as you can see over there, which means that the peak that we have just witnessed forming in the market is most probably the peak of the 40-week cycle. So now I hope you can see why it is that I say that the peak that is formed in the market is of at least 40-week magnitude, because both of my analyses are telling me to expect a peak of that magnitude, at least. And so therefore I believe that the peak that is formed is of at least 40-week magnitude. However, I think the chances are really good that it is a higher magnitude peak because of the analyses that I've been looking at in the other markets in the United States. It is quite probably a peak of 18-month magnitude, and possibly a peak of even greater magnitude, 9 years or maybe even 18 years. But before we actually confirm it as an 18-year cycle trough, we would need to see what happens to price here and watch it as it comes down. If it doesn't come down hard and in a prolonged fashion, then of course we'll say, well, it was only a 40-week cycle peak. So final comments in terms of today's video. Let's take a quick look at the composite model line, which is a very useful line to see what the analysis is telling us to expect. This alternate analysis is telling us to expect one more peak over here, after which the market is likely to move down into at least the middle of 2021. Then it kind of flatlines, and in fact it moves down even further. And let me just zoom out. All the way to give us a really big picture of what's expected to happen. There we go. This is a really big picture, so don't take screenshots and plan your trading on the basis of this. It's very speculative, but the alternate analysis tells us that the big peak is still expected, and then we're going to have a move down all the way into 2025. Okay, and the default analysis performed by Sentient Trader, and let me just zoom all the way out on that as well, and let me show the composite model line there. The default analysis is telling us that effectively that peak is expected about now. We might see a bit of a pullback, but then a move down into 2021, pull back up, and then a drop down deeper into 2025. So you can see that in terms of the really big picture, both of these analyses are telling us to expect very much the same kind of thing, which is that a peak is expected now or within the next few months, after which we're expecting strong moves down, as you can see over there. Remember, the composite model line is not an absolute projection. It is telling us what the analysis on the chart is telling us to expect if that analysis turns out to be correct. I hope that you have found this market update useful, and please let me know if you have any questions or any comments about it in our YouTube comments, or you can email us directly. I look forward to hearing from you.